Today, I am joined by Deborah Benton, founder and managing partner at Willow Growth Partners. In 2014, Deborah launched Willow Growth Partners with a focus on investing in seed stage consumer brands and enabling tech companies. During this time, Deborah assumed a number of directory and advisory board roles, supporting successful growth and development of her portfolio companies. Prior to investing, Deborah held executive level operating roles, including president and chief operating operator of Nasty Girl and Shoe Dazzle. And here she is today talking with us, which is super exciting. So welcome, Deborah.
Oh, thank you so much. I appreciate you having me.
It is so nice to spend time with you always. And especially exciting to have this conversation because you have been one of my mentors. I don't know if you really realize this, but you have been one of my mentors in becoming an investor, being slightly further and slightly more experienced in this field than me. So that is an honor to have you here and for us to chat about investing and startups and all this life that we share together. So here we go.
Thank you. Thank you for that.
Tell me, Deborah, I'd love to go back in time just a little bit to your own journey of working in startups. Tell me a little bit about your early career and the journey of becoming a chief operating officer. That would be super interesting, I think, to start us off.
Yeah, definitely. I finished business school in the late 90s in Canada, actually, and quickly found my way to the United States. Did a couple of years of management consulting. When you come out of business school, especially back then, there were kind of two tracks. You either went into investment banking or you went into consulting. I took the consulting path, fantastic training, really, kind of post-grad helped me develop critical thinking skills, problem-solving skills, problem disaggregation, working with a lot of data. It was a great foundation to launch an operating career. I ended up following one of our clients. He had just become the CFO of eToys, which was one of the original direct-to-consumer, companies back in the late 90s. It was a crazy, crazy exciting time. Incredibly smart people really trying to change the world of consumer and how consumers shopped and discovered. Just incredibly exciting time. The business model, the business models back then didn't exactly work out. We hadn't really thought through a lot of it, but venture capital was abundant and available. We ended up raising a ton of capital from, some of the most incredible Sand Hill Road venture funds. And this was really my introduction to venture capital. I really knew nothing about it prior to this time. So it was kind of baptism by fire. It was an incredibly exuberant time, and companies were getting funded. All the legend about companies getting funded about an idea written on the back of a napkin and things like that. Like, it was really quite true. So therefore, for a couple of years, grew very quickly, kept raising more capital, and eventually took the company public, which was really kind of insane because we were losing so much money. And all of the metrics that we really look to today for guidance of the health of a company, unit economics, margin profile, growing in a very healthy way. We didn't know any of it back then. Plus the cost structure was really very different. Now when you go to launch a brand on the D2C side, many of your costs are variabilized. And so the cost, the capital that you need to actually launch a brand has come down precipitously. Back then, everything was built in-house. So your WMS, your order management system, everything was in-house, and it costs tens of millions of dollars. So incredible time. Company went public. For a short while, we were all just, thinking that this is amazing and we're going to retire at 27. And well, then, reality took hold. March of 2000 hit, financial crisis. And there was just a lot more scrutiny, obviously, in the public markets. Is this really a viable business? So that was my first kind of day of reckoning of, ooh, wow, we just all really got spanked. Venture capital is great, but really, how should we think about this? And should we be thinking about this for consumer brands differently than technology companies? Back then, it was considered a technology company simply because technology was driving everything within the company. We were building, we had a lot of engineers building everything internally. Fast forward, the company was delisted, eventually went bankrupt. I think a lot of the IP was sold off to Toys R Us. Very sad day, but wow, what an incredible experience and an incredible set of lessons. I then, all the VC capital in LA dried up at that point. I joined a company called Teleflora. Many people will know it's the flower company. We had a network of about 35,000 florists, and we were really the central player that supported them in a wide variety of ways, not the least of which is acting as an intermediary between where you might purchase the flowers and who you want to send it to. So we were kind of the technology platform there, and we took a little piece of that revenue. Completely different company, incredibly profitable, very mature, in a very different life stage. And it was great because I was given a $100 million P&L to go and run. So it was a really great general management experience. And I sat on the executive team, and I did that for a number of years. And getting a taste of that, kind of juxtaposed with where I had just come from, I knew I wanted to be somewhere in the middle. I really missed the exciting early stage fast growth. But I took those principles of running a profitable company. This is where we need to end up being. We're really in the pursuit of maximizing shareholder value. So how do we kind of reverse engineer into these earlier stage companies and ensure a high integrity path? So I left and went back into the early stage world. In 2008, I met Brian Lee, who is the founder of ShoeDazzle, a very prolific entrepreneur here in Los Angeles. ShoeDazzle was one of the first companies to become the Web 2.0, which is in the introduction of a soft subscription. We had changed our relationship with the consumer. We really wanted it to be pro-consumer, a great experience, none of this kind of gotcha of past subscription models. So I joined as chief operating officer, such an exciting time, amazing group of people. Again, followed the same playbook, raised a bunch of venture capital from top VCs, focused on top line growth, really didn't focus on, what I think now are the key metrics of growing a very sustainable brand. Kept raising too high valuation, too much capital, not thinking about profitability. So, I was kind of repeating all of these lessons, but don't forget at the time, there was no other capital at that seed stage. The only capital available was this, really coming from these tech VCs. I left, I had no intention of leaving, but I got drawn away by an incredible young woman, Sophia Amoroso, who had founded Nasty Gal, which was this, explosively early growing women's company, starting with apparel and then launching into other categories. And she had done an incredible job of bootstrapping the business to about $20 million in revenue, an incredible accomplishment, all the while building a really incredible brand. And I joined, and, she'd been hounded by venture capitalists. We ended up raising $40–50 million at just a crazy high valuation. Again, kind of repeating the mistakes of the past. But again, you have to remember back then, this was 2011, 2012. This was the path. This is all anybody kind of knew. And there was no discussion of, okay, well, what are the implications if you raise at, this crazy high valuation? What is your investor underwriting to, or what are the expectations of those kinds of returns? Because that investor has raised capital for their fund, promising a certain returns profile. So that discussion never happened. Again, I can talk about this now because I've been through all of it. At the time, it doesn't occur to you. You're just doing kind of what is expected. Raised a ton of capital, grew from 20 million to roughly 80 million in revenue in 2 years, insane growth. A lot of things broke, not focused on the right metrics, a lot of churn, leaky funnel. And then at some point, Sophia had a lot of interest to go and open up a bunch of retail stores, not so much my expertise. It was a good time. And by this point, a lot of it was happening in the environment as well, that I could see these beautiful brands, because of their capital structure, frankly, and the expectations that were placed on them, were kind of losing their way. So I left in 2014, and I was seeing I was probably from a mindset for these consumer brands more focused, more aligned with a private equity, very early growth model, rather than kind of this venture, which is grow at all costs, boom or bust, $1 billion, or it's not worth our time kind of thing. I had really solidified my thinking of what is the right path for these brands. I was neither a private equity nor tech venture. And there was no fund that was really thinking about this the way I wanted to think about it at the seed stage. So I started investing just off my own balance sheet. And I was an angel investor from 2014 to 2019. I was taking a lot of board seats as well as writing a check. And really helping these founders mostly, not make the mistakes that I felt I made, really grow a lot more methodically, being there to support the founder. It's a very difficult journey, as you well know. You had an incredible accomplishment with your business, but it can be very lonely and it can be very difficult. And especially if you don't have the right financial partners, where you have a misalignment at the board level, it can be, very difficult for sure for everybody. So I did that. I made 15 investments, again, took a lot of board seats, so got heavily involved with these businesses. And that cohort was incredibly successful financially and for the health of these companies. And all this time I'm seeing, I never invested through a gender lens, but 3/4 of my companies were founded by women. There is internal bias with all of us, for sure. There's no question. I really love the style of, how women generally work. I find it tends to be more collaborative, more transparent, more team approached, and I really enjoy that. I also think that there's an amazing opportunity for women as they control the vast majority of the household wallet. They're out spending. They're the ones that are really buying from the brands. And their relationship, I found, with brands was changing. People were becoming a lot more concerned with what the brand stood for. And if I'm going to spend my hard-earned money, do I feel aligned with you from a values perspective, which I think was, a wonderful evolution. So on the back of the success of that portfolio, seeing this absolute dearth of women writing checks and women starting funds, which was infuriating, because there's certainly a correlation between who gets funded and who's writing the check. That was really a very strong personal motivation for me to get into the check writing business and to launch a fund. And that's how Willow was born.
I love, there's so many things I love about that story. I love the fact that you were thinking about investing in a way that no one else was thinking about investing, particularly because you'd had firsthand experience of being an operator. And so one of the frustrating things, I think, for many entrepreneurs is having investors who are backing them with a financial mindset without an operational focus in terms of figuring out, what does it really take? What's the real hard part of the graft of actually building a company? Because that's really hard. It's really hard to build a company.
Absolutely. And it's those intangibles. Like I would say, and I had my fair share of frustration with financial investors as well. They all mean well, but they only see kind of the post numbers, post everything, what goes into it, and the intangibles and the nuances of running and scaling a business. It's very hard for them to understand unless you've done it. It's so difficult. You're dealing with a lot of people, a lot of ambiguity, different motivation sets, different skill sets. Sometimes you're outgrowing people very quickly because you're scaling so quickly. It's that element that I probably spent at least 50-60% of my time on the human element, the most important element, unquestionably. But, it's not as easy as just saying, cut these costs or get your margin up or raise prices. Those are kind of some of the easier issues to deal with. It's really more of the intangible of building a business: culture, motivation, your human capital, the most important thing. Yeah,
absolutely. I love that. I also loved, what I love about Willow has been your intention from the beginning to help women think about increasing their wealth and helping women understand the venture space. And one of the things I think you've done really, really well and very intentionally has been to help educate women about the space and help them think about what it means to invest and why you should invest, and helping women open their wallets, because it is super important that women build wealth, because if we build wealth, we'll be able to create more wealth, and we'll be able to do the things that are not getting done right now because of who is writing checks right now. And I love that about you. So tell us a little bit more about that and the whole thinking as you started to launch Willow.
Yes, what I saw very clearly, look, I even in undergrad, I was in maths and sciences. I did an MBA, predominantly male dominated. I never really thought about it, to be perfectly honest. It just kind of was. I was, I competed athletically as a young child. I think I was, it just kind of was. I didn't even have any brothers, so I had nothing really to compare it to. So I didn't start out my career with this, oh, wow, there's so few women mentors, there's so few women at the executive level. My mom had also, was always my dad's equal professionally. They had the same degrees. They both had master's degrees. They started off as teachers, then became principals, then became superintendents of education. So I hadn't even experienced really any kind of disparity at home either. I think that probably helped me. But what I did notice as my career evolved and as I was moving into more senior positions, I clearly saw a correlation between capital, whether it's access to capital, having capital, being able to create wealth, and power. And I use the term power not in a negative way. It's quite a positive way. You think of it rather, sometimes it has such negative connotations, but think about it as freedom, the ability to make decisions that are right for you, the ability to influence or create change. It takes capital. It really, really does. And the more that I experienced it in the early stage world, seeing women entrepreneurs, extraordinary women entrepreneurs. By the way, I just want to mention every single liquidity event I've had, and I've had a number now, have been women entrepreneurs and women founders. Wow. So keep that in mind. But I was seeing women just really struggle with raising capital. And it was this dichotomy I couldn't quite understand, because they were clearly so capable, building such incredible businesses. And they just couldn't. Something was happening when they were going to raise capital. And I believe, my thesis is, even if you go in with the belief that, look, we're all trying to do the best we can, there is just inherent internal bias, subjective bias. We are human beings. We
like what we like, right?
We like what we like.
And to like things that make sense to us, and people that make sense to us. 100%.
Yes, absolutely. I love investing in beauty brands because I know that category. I use the products. I relate to it. I mean, there's nothing wrong with that. That's just how it is. When you have 98% of the world's global assets being managed and allocated by white men, there are significant implications to that of how that capital is getting allocated and how that capital is being used. And if you think about it from kind of the exponential effect that putting more capital to work by women can have, and I'd say women from all ethnicities, all backgrounds, this goes just beyond gender. This goes into, many aspects of kind of demographics. You just get much better represented capital. And we don't have that right now. We have a world that, for the most part, has been created and supported mostly by white males. This is not a bash on white males. All I'm saying is that we are missing tremendous opportunities. We're just missing amazing opportunities. That's the most innocuous way I can say it. So, when I was seeing this, it was very frustrating. I was also, because I was constantly helping these companies raise capital, I had a strong network of amazing women that had a lot of success, that had capital at their disposal to start investing. There just was a huge lack of confidence that a lot of women showed me that they just couldn't write a check. They were happy to give $1 million to charity, but to actually go and invest was a huge hill for them to climb. And I think it's a confidence gap. I also think that there's an element in society where women and men think it's not ladylike, appropriate. I don't know. It's crazy to me because, I can't think of anything more exciting or anything more wonderful, but there's definitely still some stigma attached to women, making money and being competitive. And, in this world of, high stakes deal negotiation, there is, I think there's a few things. There is a lack of education, a lack of knowledge, a lack of confidence, and this very unfortunate kind of legacy stigma around women being involved in this world. We need to eradicate all of that. I would argue that many of we will not see, we've made a great deal of progress for women in general. Terrific. We will not see the kind of equality that all of us want to see, that I think will benefit the entire society, not just women, until we eliminate the disparity in access to capital. It is first and foremost the most important element. When you have such deltas in access to capital, in having, as an individual, having your own capital to have the freedom to make choices that are good for you, we cannot solve many of the crises that we have at a societal level until we solve that. And so that was, there are many stakeholders in all of this. I wanted to support more women starting businesses. Those women will hire more women at the executive level. They will put more women on their boards. I wanted on the LP side to get more women involved in investing in a fund and creating wealth for themselves. And to me at the center of that, I can encourage and educate women to invest, to then help them create wealth. And me as an allocator, with an eye on these businesses that a lot of women tend to start, I can allocate capital. They will then hire women. They will place women on the boards. For me to do this at a fund level, I was doing it as an individual level. I could have much more impact at a fund level, writing bigger checks, being able to control the deal dynamics a lot more. That was tremendously exciting to me.
Very exciting. And you closed your first fund 2020? Did we close in 2020 or did we close?
Launched in 2020. Great timing, right? February of 2020. That would be 4 weeks before a global pandemic shut us down for a few years. We launched it. We did a first close in May of 2020. We closed the full fundraise 12 months later. So it's been
extraordinary. Really
extraordinary. It's been incredible. And, you are one of my lovely LPs, which I'm thrilled to have. We have an extraordinary investor base. Entrepreneurs, professionals, family offices, terrific endowments, some women's syndicates. It was an extraordinary year of my life, meeting the most high quality people that just were so aligned with what we were doing. That felt really, really good.
And really powerful. Like you just said, there's so much power behind that. When women are getting on board and thinking broader and wider than they've ever thought before, and feeling confident to step into an arena that they may not have felt confident in previously.
Absolutely. And when there's a community element, one of the things, I look at all aspects of my life, personal and professional. Women are drawn to communities. We are drawn to communities. We could have a huge sociological discussion of why that is, and that would be super interesting to have. But my belief is we are drawn to communities. We're drawn to communities where we feel alignment, where we have social connections, where we enjoy ourselves, where we can, ask for help, be of help. We function generally very well like that. And this has been, that's a key thesis that we invest behind as well with brands. I think really successful brands either come to market with embedded communities or create very powerful communities early on. And that's life-sustaining for them. They can then use that to activate, to bring more people into the fold. Brands are far more than the product that they sell. I think brands sell feelings, and I think that they sell a admission to communities. That's kind of how we invest. And if you look at our portfolio, you'll see kind of very distinct communities.
I love that. I think that's a really good translation from the investor base also over into the companies themselves that you are helping to grow and spearhead and push forward and help them succeed. And in that vein, give us some of your early stage investor advice to young, or not necessarily young, but entrepreneurs who are at the early stage of their business life cycle and trying to grow and trying to scale and thinking about being investor ready. What would you say to them?
I'm so glad you caught yourself, by the way, with using the term young entrepreneur.
I have some older investees that I am invested to, and I was like, it's definitely not just only for the young.
Oh gosh, no. And I think we should really eliminate that notion out there. First of all, some of my absolute best founders, hands down, are not young founders. They're not in their 20s or 30s. I mean, you well know this as a founder, you bring everything that you've experienced from life to that business, everything. And I'm very excited to invest behind more mature founders that, high level of self-awareness, have great life experiences, can manage people really well, great leadership skills. All to say, I'm agnostic, open to everyone. But to become investor ready. So there's a few things. I am far more on the spectrum, far more conservative in terms of how much I want founders to raise capital. In other words, I am highly encouraging for founders to build real sustainable businesses almost from day one. That doesn't mean that they'll be profitable from day one, because it does take capital to get off the ground. It does take forward investment to accelerate growth. So I understand all of that. But, my hope is, and I have this conversation with founders, my hope is that they raise as little capital as they need to achieve what they want. And that's a constant conversation. And there's lots of exogenous factors that we can't control. And so, every few months we have that discussion, where are we at, what do we think, and the competitive environment changes and the exit environment changes and things like that. So, but it is a constant conversation. We at Willow, we are looking for companies that are doing 2 to 5 million in revenue in trailing 12. And I know for somebody starting out in a business, that sounds like, that sounds like a huge level to get to. And in many ways it is, no question about that. You've already achieved, a lot of product market fit at that point, which is what we're really looking for. But I encourage founders not to raise institutional capital prior to that, because I think when you have too much capital on the balance sheet, as a founder, you're not forced to make really important trade-off decisions of how to grow. There is a method to the madness of staying very capital constrained, appropriately so, not so that you're running on fumes, but appropriately so that you are forced to really understand the business and really understand the metrics in the business and make trade-off decisions. I've seen so many companies that have gone out and by the way, I made this mistake as an operator, raised a ton of capital. You know what happens when you have a ton of capital on the balance sheet? You tend to spend it. And you're not forced to make really difficult decisions and grow in a super healthy way. So my advice to founders as they're thinking about, or maybe they've just launched a young business, friends and family capital if you need some. There's other mechanisms. There's loans. There's small business loans. Depending where you are in the world, some of these commercial banks and some of these cities have set up programs. You have to get super scrappy, very, very scrappy. There's some women's groups, some women's angel syndicates. It's hard, believe me. Fundraising, no matter where you are in the cycle. And by the way, we fundraise as well. So, my heart goes out to anybody that is fundraising. It's really hard. It's very difficult. You are, especially in those early days before you have, really a viable, sustainable business, you are selling yourself. You are asking people to invest in your vision, in who you are, in what you can convey to them that you can accomplish. And it's hard, and it is not for the faint of heart. But that's my best advice is, if you can raise some smaller dollars through, get very creative, get very scrappy, through loans, angels, friends, neighbors, former teachers. I mean, I've seen a lot of it. That is the best way. And you don't have to, because, you don't become $100 million brand overnight. You can start off in farmers markets. You can start off in your neighborhood. You can start off at your local store, getting consumer feedback really early on to help you ensure that you have product market fit, that you understand exactly what the consumer, where they're deriving value. There's, it's important to start with a certain thesis as you are building out your business, but checking in with your customer very frequently and really understanding how they are experiencing your brand is unbelievably important, no matter what stage of the business you're at. I find brands do not check in with their customers nearly enough. So, at the early days, getting off of the ground is big, starting to generate revenue, get consumer feedback, start to understand how you're acquiring customers, start to understand how they're sticking with you. Iterating on your product or products. All of these early aspects are super important. When you've figured out many of them, not all of them, when you figured out many of them and you start to have a good understanding on your initial unit economics, you've worked out some kinks in your supply chain, you understand kind of where you stand in the world with your consumers. You're at that, for a fund, you're kind of at that level of, for us, it's, 1 to 2 trailing 12 million. That's a great time to start to think about institutional raises. And we, our raise is generally a $2 to $3 million round. And, we have certain ownership targets that we're looking. We like to take a board seat because we will really work with the founders. But that's generally the cadence to get to kind of institutional funding.
I think that's really helpful. And I love that piece of advice, which was stay scrappy throughout the journey, not just at the beginning, but especially at the beginning, and not overspend, because that's the challenge. Once you've spent too much capital and you've got a lot of capital on your balance sheet, if your next raise can't justify an increase in valuation because you haven't generated ROI from the capital that you brought in, that's going to be bad news for your business. And maybe you've had a great business, but now it's seeming like it's tanking when it really isn't. But
absolutely, that's absolutely right. And that path, like really understanding that path, I'd encourage founders very early on to get educated on that. Investors, you have to keep in mind, as an investor, we see probably 1,000 companies a year, right? 1,000. It's very easy to say pass. It's very easy. So don't give investors any kind of very quick apparent reason to pass. Capital structure problems, valuation issues, spending too much money. It's already a heavy lift to launch and scale a business, as you know. Don't make it any harder for investors. Be kind of very, very thoughtful. Reduce the friction as you're talking to investors.
Yeah, I think that's super helpful. And I think it also changes the shift from thinking about what success looks like. And it's easy to think success looks like having raised a lot of money, or success looks like having had a high valuation for your company. And I tell my founders all the time, it doesn't really matter what the valuation of your company is, because it's not real money until it's in your bank account.
It's made up. It's absolutely made up. It's a complete fabrication. It is a complete fabrication. This is such great advice, my friend. What I tell people is, please don't get caught up on those numbers. Think about your ownership. If you really want to focus on something, think about your ownership. It may be more prudent to raise less at a lower valuation, take the same level of dilution, and it will get you all the more farther that if you have to raise again, you'll get a much bigger valuation and raise less. So your overall aggregate dilution will be lower. So thinking about it in terms of protecting the ownership And definitely not optimizing for valuation, really being very thoughtful about the partner you're bringing on. You're getting married, make no mistake about it. And unlike in real life where you can, without too much
divorced.
you can get divorced in this world. It's very, very, very
much
unlikely.
harder to get divorced to an investor.
Much, the acrimony, arguably is more. So being very thoughtful about who you're partnering up with. I would highly encourage people to court investors, get to know them, spend time with them, ask them about their values, ask them about, how do you deal with conflict? How do you work? Back channel references, talk to founders that they've worked with. All really, really important.
Yeah, really important. I know Willow prides themselves on considering themselves founder first investors. Tell me what that means to you.
Yeah, it's, again, because I operated for so long, I was always the kind of the professional operator that was brought in to sit beside founders. And so I had a very unique experience of, seeing firsthand, gosh, just the emotional journey that founders go on. I think it is just very much underestimated. We always see in the press like these, rags to riches stories and these overnight successes. There are zero overnight successes.
Alive. Yes.
It's like most overnight successes are 12 years in the making. I mean, it's incredible. And I think the psychological challenges that founders experience are not talked about enough, ever. And we really should be having a much more open discourse about, it's the ups and downs that they don't happen over the course of a month or a week. They happen within a day. They often happen within an hour of, ooh, this is great. Oh my goodness, this just happened. So it's those constant ups and downs that, again, the vast majority of people were not made to withstand. They just, the constitution that you have to have, the mental strength, the physical strength of being able to manage the volatility, the emotional volatility, the business volatility within very short time spans. It's almost inhuman. So I think because I've had very close experience with founders and being kind of the operator that sat beside the founders, trust me, I went on those journeys as well. I think it's really important to have that perspective and to understand and to work with the founders. They're human beings, they're human beings. Nobody's perfect. People make mistakes. And that's why the relationship for us is so incredibly important. Building that trust up front, creating a safe space that people will be making mistakes. They may make the wrong decisions. This is, we are the antithesis of kind of this finger pointing culture. We are there. We are part of your team. If you make a mistake, let's talk about it. We'll work on it together to fix it. That is very important to us. And that's why we tend to spend quite a lot of time getting to know founders before we lead an investment, because that relationship is just so important.
The relationship really is key, and as you said, it is very much like a marriage. So making sure that you like the person that you are marrying is really, really critical.
Yeah.
But I just love that sense of thinking about how you not just connect with your investors, but how you build a network of people around you to support you, because this journey is so hard. And I say to my investees all the time, and the entrepreneurs that I work with, this is about staying in the game long term. Yes. And how do you keep getting back up after that you are whacked down? And you may get whacked down like 10 times a day. And can you find the strength to keep getting up? And what does it take to do that? And I think surrounding yourself with people, with cheerleaders and supporters and people who can help pick you back up when you get knocked down, because you will, is super critical.
Again, it comes back to this idea of community, and the brands that I have seen succeed the most have been exceptional about creating a community, the founders, the community around them. And that can be investors, it can be customers, it can be board members, it can be advisors, it can be your suppliers, it could be, your friend that works at investment bank because you're getting information from them about the market and what's going on. It can be potential acquirers. Like, the community can come from lots of different places. But we are operating within an ecosystem. We are not, too many founders try to do this in isolation. And first of all, it's very, very lonely. And founders' vision and their dreams have to be informed by some of the reality of which we're operating in within the ecosystem. And so, building relationships with various stakeholders within a broader ecosystem will only be helpful. And having some of these folks, and they play different roles. The role that we play when we first lead a seed stage deal, the role that we play as a board director at that stage is very different than the role that we play when they raise their Series A. They don't need us as much. They need us in different ways. So the onus is on us to evolve our role as the founders' needs change, as the business needs change. We have to change, and that's really on us. And again, the degree that we can be successful goes back to the degree that we have a strong, trusting relationship with the founder. And that, if I think about, what is the linchpin to the success of all of these, it comes back to a trusting relationship with the founder. We'll go through lots of ups and downs. We may go through conflict. We'll go through disagreements. That's all healthy. That's actually super healthy for a business. But mutual respect, trust, I've got your back. We can talk about anything, even if it's really challenging. We need to have that relationship. We strive to have that relationship.
This is decades of wealth of knowledge coming out of you, Deb. Thank you so much. It's so
all the mistakes I've made.
But that's what's really powerful, right? It's like, these are the learnings that are really important. And these are the things that matter. And these are the things that are become linchpins for helping make things work. And entrepreneurs are often looking for sort of like the secret sauce of what makes somebody successful, or what makes their startup more likely to succeed than somebody else's. And it's some of these things that we're talking about, and they are the soft skills, which, actually are the really meaty skills that really make a difference. And I think that's really powerful and really helpful. Tell us a little bit about something that Willow Ventures has on the horizon that you're super excited about, or that you're doing at Willow that you would love to share with us.
On the deal side, a specific deal, company,
not
brand?
Necessarily, just something that's coming down the pipe that you are excited about. Or
I mean, the great thing about this, a great thing about this industry and doing what we do is every day is different. Like, there's no 2 days that are the same. There's a great deal of variety. There's a lot. We also feel, kind of all of the ups and downs that all of our portfolio companies feel, which is interesting, exciting, but sometimes really challenging. I mean, I guess if I have to pick one thing at a high level, we are gearing up to go raise our next fund. We've had a great deal of success with this first fund, and we're about 3/4 deployed. So we have a few more partner brands that we will lead deals with in the next probably 3 to 6 months. But we're having early conversations about the next fund and building off the success of Fund 1. That's very exciting to me. Again, it's less about the achievement of getting to the second fund. For me, it's, the even stronger impact and broader impact I can have with a second fund. It's extraordinarily rewarding.
Yeah, it's continuing to do what you love, because it's obvious that you are super passionate about this space and super passionate about investing in great founders, and levering that passion for impact. And impact at the end of the day, making money is great. Making money is fantastic. But as you said, at the end of the day, that's currency for driving change, making a difference, building the world that you want to see, and making things happen that you care about. And that's ultimately what I think it's all about.
It's unbelievably rewarding having the ability to back founders that I believe are they themselves going to have an impact, and their companies are going to have an impact, and their success is going to have a bigger and bigger impact. It's now, what I was doing as an individual was great, don't get me wrong, but my checks were a lot smaller. My impact could be less. I could do 15 companies. I probably couldn't do much more. Having more capital allows me to direct that capital in a way that I think is ethical with incredibly strong returns. There's a misnomer out there that, to have impact, you take a hit on returns. I think it's actually the exact opposite. For us, we back values-led founders and brands. And I happen to think that's exactly how the world is beginning to shop and spend. So I think there's a direct correlation between backing, these incredible founders, many of which are women and other minorities, because they're finding white spaces in the market, and financial success. I think there's a direct correlation in that. So it's, when I talk to investors, limited partners for the fund, that's something that I address all the time. There is really this misunderstanding in the market of, impact means lower returns. Not at all. Certainly not at all. I mean, first and foremost, we're very clear and transparent about our thesis to our investors, but we are projecting incredibly strong returns.
Absolutely. Couldn't have said that better myself.
We've always been very aligned, Sarah.
We have, absolutely. Tell me, Deb, what is one change or several changes that you are hoping to see in the years to come, and how is Willow contributing towards that?
Oh gosh, I want to see many more women getting funded, and not just funding at our stage, but funding the big funding that might come down the pipe. I want to see many more women founders having incredible liquidity events and generating a lot of wealth, because again, there's a circle of capital. When women founders have liquidity events, I've found that they invest in other women, either through angel investing or through fund investing. And so again, this is a broader circle, right? If more women can generate wealth for themselves and then invest, and in turn generate more wealth for themselves and invest, and in turn, and who they're investing in does tend to be women and other minorities, who then hire women and other minorities and put them on their board. That is an exponential improvement that I'm very excited to have some very small part in.
That's a game changer. That's changing the whole ecosystem of the way the world works right now. So it's big. It's huge.
Well, fingers crossed.
We can do it. We can do it. One woman at a time.
Yeah, we are doing it. I mean, I just saw some recent numbers in 21 that were a little bit depressing. We're not changing fast enough. I guess that's what I would say. We're not changing fast enough. And over, I think in 21 and 22, we saw a little bit of a regression on some of the key metrics that I think are really important. That's a little bit depressing. But look, we get up every day and we do our best. And I think I can hear, I can feel the momentum building. There's definitely more women like yourselves that, have a different kind of background, doesn't have an MBA from Stanford, that went to work at a big private equity firm, that branched away to start their own, different kind of background. My background, very different. I'm definitely encouraged by the number of women that are starting funds, raising funds, and allocating. But it doesn't happen overnight, but we just have to stay at it, and we need to support other women. We have to support other women. I say to everybody that I talk to, no matter what walk of life they come from, schedule 30 minutes a week just to give back in some way, in some way. Founder, fund manager, your neighbor, like what have you. But can you imagine the impact that we can have if everybody has 30 minutes, just make that part of your weekly habit. it's a good habit to have, and we can move things along faster.
That's a great way to close off our time together, Deb. Take 30 minutes to give back every single week. I love it. What a great idea.
Minutes. Get off the social media platforms.
Yeah, I love it. How can people stay in touch with you if they'd like to follow Willow or follow you and keep in touch?
Would love that. Yeah, would love that. Definitely reach out to me, connect with me on LinkedIn. Willowgrowth.com is our website. You can connect through there. You can join. We put out a newsletter every few months. Definitely join on our newsletter to keep updated. Take a look at our website. You can see our portfolio companies. We're always hiring, by the way. Our companies are always looking for amazing talent. So if you're interested in some of those companies, please reach out. Yeah, I'd love to get in touch with people, founders, operators, investors. Building the ecosystem and building the community is a big part of my job.
I love it. Thank you so much for your time, Deb. It's been absolutely fabulous having this time together and a chance to hear your story. Thanks so much.
Thank you so much for the opportunity. Very much appreciate it.